The employment is rebounding, apparently. Why is it rebounding? I never understood it until I came here. The initial unemployment claims have been dropping and the continuous unemployment claims have been dropping, and somebody told me if you're in the system for long enough, they don't number you anymore as a claimant, therefore it needs to start falling after a certain period of time. So that's one explanation. And non-farm payrolls have been increasing, so that's a bit a good indicator. The last two things that improve from a recession is unemployment and housing. So these are the two that usually recover the last. You can see that housing is stabilizing. We couldn't say that it's rallying like the rest of the commodities and indicators, but it's at least stabilized. There are certain reasons why it's stabilized, which is the first-time buyer tax credit, and there's another housing credit, which is for the second movers, and you need to. It's kept by income, I think. So, but that has stopped the prices from falling, and existing home sales have picked up. So, I'm almost finished. We'll look at equities now. So equity is continuing to rise on better expected earnings. Over the last few weeks, you could have seen the earnings have been fairly good. Question marks, how did they achieve these earnings? Retail sales good, durable goods orders good, manufacturing good, output okay, rising confidence levels, stabilizing unemployment and housing. You could have made a picture of why oil prices are rising. And Bob asked me to look at the US financial regulation reform. If we isolated all the drivers I spoke about, it would have given you a mixed picture. On one hand, you have improving economy, which could be on artificial support line. On the other hand, you have quite a low demand and plenty of supply. So we would expect the market to be balanced. I personally would have expected prices to be around maybe $50 per barrel, but they are around 82, and that's surprising. I don't know how many of you know how much it costs to get the oil out of ground in Saudi Arabia. So you have oil trading at 82.44 today. You can get the oil out in Saudi Arabia or Kuwait out of the ground for $2 per barrel. On top of it, you add some operational costs, and you get to $10. So you get it out for $10, and you sell it for $82. You make a nice profit. Some countries like Venezuela, who have the heavy oil sands, they get it out for about 60, 70. I know in the news you can see figures like 110 and 150 and crazy numbers like that. But it's not that expensive. It's people are looking forward rather than what the picture is now. And then the US financial regulation reform. There was a big press coverage of it yesterday because it was not passed, and the Republicans managed to stall the progress of the reform. The reform is expected to pass, but a bit of history behind the reform. On July 7th, 2009, US crude oil prices hit record high, above $147 per barrel. Lehman Brothers then fell, started global recession. It wasn't just that, but it was the high oil prices helped. On June the 17th, President Obama outlined vision for biggest financial reform since 1930s. And then the US House approved bill to overhaul financial regulation. CFTC, which is the policing body, the Commodity Futures Trading Commission, proposed position limits for energy futures contracts and started a consultation, which expired yesterday. And then US Senate Banking Committee passed financial bill. Goldman Sachs charged with fraud not long ago. US Senate Agriculture Committee passed bill to regulate OTC derivatives. And yesterday, US Senate reform package faced key vote. What's in this major reform proposal? And by the way, the chart you can see there is open interest in commodity futures. And you can see that the open interest is almost at the same level as it was when oil was hitting 147. What does it tell us? The speculators are piling money into the fuel markets. I just read this morning that contrary to what Wall Street is saying, they cost us 300 billion. Speculators cause oil prices to be inflated by between $15 to $30 per barrel, which would equate to, if we used only $10 per barrel inflated prices, that would equate to 300 billion worldwide. The major reform proposal is covering 10 areas. Number one, preventing more bailouts. We don't want more bailouts. Apparently 75% of Americans don't want any more bailouts of companies like Goldman Sachs and co. Protecting consumers. So us as consumers will be protected from high credit card rates. Volcker rule, which would strip banks from taking crazy risky positions with customers' money in areas which the customers have no interest in. For example, lean hogs somewhere in Asia, and they'll be using your money for that. Over-the-counter derivatives would be policed. They would prevent systematic risks. Banks would be policed. Banks with over 50 billion capital would have to contribute to a fund which would hold 150 billion. Executive pay and shareholder rights would be reformed. Hedge funds would be regulated. Hedge funds made a huge amount of money on your recession, on our recession. Goldman Sachs made a huge amount of money on housing falling. You just bet the other way. You just go short or naked short. So some people make quite a bit of money, and hedge funds didn't have to disclose that amount of money, but some of them would have made trillions of dollars. And the last one would be cracking down on credit rating agencies like Moody's and Standard & Poor's. The main reason is you could see what they did today. They just downgraded a debt of a country by two notches to junk, and the Greek stock market fell by 5.9% in one day. So they've got a lot of power, and the danger is if they get together with the investment banks, they can pretty much control whatever happens to you. Sometimes it's a game with a zero sum. Therefore, somebody needs to lose, somebody needs to gain. If somebody gains, somebody needs to lose. You start asking question, who is the loser here? And with regards to energy, how is it affecting us? I know Bob is a member of NEFI, and I looked at their position, and NEFI is New England Fuel Institute, and they are very supportive of strong new legislation to reform unregulated derivatives markets. They support limits on speculation derivatives to move to clearinghouses and data transparency. They want to expand the authority of CFTC. With regards to the position limits, there's lots of noise about it, but it will only affect the large 5 or 6 speculators and investment banks. So it will be again Goldman Sachs, Morgan Stanley, Deutsche Bank, JP Morgan. It would limit the influence of big traders in energy markets. It would prevent excessive concentration and speculation. And the commodities that would be affected would be natural gas, crude oil, heating oil, and gasoline futures and options contracts traded on NYMEX and Intercontinental Exchange. Entities using the futures market to hedge commercial risks, like Hedge Solutions, would be exempt from position limits under this proposal.